Welcome back to the Options Academy. In this presentation, we will discuss one of the most common option trading strategies, butterflies. What are butterflies? I know, this sounds like a trick question. We all know what butterflies are, right? They're what you get in your stomach when you realize you just called your spouse by your ex's first name and your spouse is a divorce lawyer. Here, though, butterflies are an entirely different species. As with other option strategies, the title of this paper refers to a whole category of structures, and it incorporates several specific strategies. Many traders who seek limited risk strategies with low risk and high reward potentials take to the butterfly strategy in its varieties. At its base, the butterfly will always include the simultaneous selling and buying of 4 options. There are always 2 options at the center of the structure, or close to the center. These options are referred to as the center options. In addition to the center options, there are 2 options on the outside of the structure, one below the center and one above the center. These options are called the wings. The nature of the trade, either selling the butterfly or buying the butterfly, will be determined by which options are sold and which are bought. It will also determine the risk profile of the trade. In this article and the one that follows, you can read and see illustrations of the different types of butterflies. By the time we're done, you'll have an entire butterfly collection. Let's take a look at the most familiar version of the butterfly strategy, the iron butterfly. An iron butterfly is comprised of 4 options. 2 options, a call and a put, are sold or bought at the same strike price. One additional call option is bought or sold above the 2 options, and one additional put option is bought or sold below the 2 options. In the iron butterfly, if the center options are sold, then the wings will always be bought. If the 2 center options are bought, then the wings will always be sold. This relationship between the center options and the wings will always determine if you are buying the butterfly, being long the butterfly, or selling it, being short the butterfly. If you sell the center options and buy the wings, you are short the butterfly, and you are looking for the market to expire as close to the center options as possible. If you buy the center options and sell the wings, you are long the butterfly, and you are looking for the market to trade and expire beyond the wings. A crucial aspect to remembering when placing the iron butterfly is the distance between the options. In the iron butterfly, the distance between the center options to the options above and below is always the same. This aspect, the equal distance between the options, is what ensures the attractive risk-reward profile of the trade. You can see an illustrated example of the butterfly on our website, theoptionsacademy.com. You may notice that an iron butterfly is in essence a combination of 2 or more basic strategies. The wings are actually a strangle, and the center options are actually a straddle. Think of it as the crossover SUV of the options world. Let's talk about the risk and reward profile. The main reason traders are attracted to the strategy is its appealing risk-reward ratio. At its highest potential, the short iron butterfly carries the promise of great profit. Yet, unlike many other strategies that require matching risk, the short iron butterfly carries low inherent risk. Low risk, high rewards. Sort of playing Texas Hold'em with 5 millionaires with short-term memory loss. The combination of built-in low risk coupled with the potential for high profit makes for a winning strategy in many minds. Let's take a closer look to understand the risk-reward profit of the iron butterfly, and as always, use the Standard & Poor's 500 for illustration purposes. For this example, we'll assume that the S&P is trading at the 1050 level. Selling, writing an iron butterfly at the money would look like this. Sell the 1050 call option. Sell the 1050 put option. Buy the 1080 call option. Buy the 1020 put option. Again, to see an illustrated example, take a look at the matching article on our website. This iron butterfly is a 30-point butterfly. If you're picturing a butterfly with huge antlers, you may be in the wrong presentation. The distance between the short options, center call and put, and the long options, the wings, is 30 points. Therefore, the maximum risk on this iron butterfly is 30 points, less the amount of premium collected at inception. Since the market level in this example is 1050 and you are selling an at-the-money straddle, center call and put, and buying an out-of-the-money strangle, the wings here are at a 1080 call and a 1020 put, you collect a hefty premium. Assume you collected 25 points. Your maximum profit will be realized if the market expires at the 1050 level. At the 1050 level, the wings expire worthless, and the center options are worth the least they could possibly be. Note that we are not referring to the center options, the straddle, as expiring worthless. This is because in practical trading, you might not be able to hold the options until the moment they expire. We would like to take a moment to explain why it's unlikely that a trader would hold the iron butterfly until expiration. Hint, it has nothing to do with having a short attention span. The options, any options in fact, will expire only after the closing of expiration date. Up to the moment of settling the underlying market, the option is still alive. Only after expiration will it be determined if an option expired worthless or if it expired in the money. In the unlikely scenario in which the market expires exactly at the 1050 level, you will have to wait until expiration to find out if both options indeed expired worthless. If you do that, you might be assigned a position in the underlying market if the settlement price was above or below the 1050 strike price, and your call or put assigned to you. If the market settles above 1050, you would be assigned the call option, which will take the form of a short position in the underlying market. By selling the call option originally, you gave the buyer of the option the right to be long in the market. Therefore, if you are assigned, you will be short the underlying market. If the market settles below the 1050 level, you will be assigned the put option, which will take the form of a long position in the underlying market. By selling the put option originally, you gave the buyer of the option the right to be short in the market. Therefore, if you are assigned, you will be long the underlying market. Either way, if you are assigned a long position or a short position, you will expose yourself to a potential loss should the next day's session open against your position. Therefore, if the butterfly is to keep its appealing risk-reward profile, it should always be unwound prior to expiration. Let's go back to risk and rewards. So you cannot really hold the position until expiration. Forgive us if hold the position until expiration sounds like some sort of sadistic thing a yoga instructor might say. Nevertheless, the attractive risk-reward profile is maintained, even if the market does not expire exactly at the 1050 level. Your maximum risk in this specific example would be 5 points, which reflects the width of the spreads, 30 points less the premium collected, 25 points. Let's see what happens if the market enters a bearish trend and expires at the 1000 level. 1. The long 1080 call expires out of the money and worthless. 2. The long 1020 put expires in the money with intrinsic value of 20 points. 3. The short 1050 call expires out of the money and worthless. 4. The short 1050 put expires in the money with an intrinsic value of minus 50 points. 5. Total value of the butterfly at expiration, minus 50 plus 20 equals minus 30 points. 6. The total premium collected at the inception was 25 points. 7. Total loss on the trade then is 5 points. 30 minus 25 equals 5. 8. Total loss in dollars, $1,250. 5 times $250 equals $1,250. Fact is that any strike price outside the limit of the butterfly, either below the 1020 put or above the 1080 call, will always yield the same result, a maximum loss of 5 points. Let's look at some scenarios of profitability. You can see that the risk profile of the iron butterfly is pretty tight and under control, but what about the potential profit? Here's the good news. Expiration within the range of the structure, even away from the center, might translate to handsome profits. Let's take a look at some winning scenarios. We prefer looking at winning scenarios because they're less depressing than losing ones. Let's look at a scenario in which the market expires at the 1040 level. At 1040, the wings both expire worthless. The 1020 put is out of the money, and the 1080 call is out of the money as well. The 1050 call meets the same fate as the wings and expires worthless, out of the money. The remaining option, the 1050, puts you sold, has an intrinsic value of 10 points. This scenario, therefore, represents an overall profit of 15 S&P points or $3,750, $3,750. 15 times $250 equals $3,750. Let's look at expiration at the 1030 level. 1. The long 1080 call expires out of the money and worthless. 2. The long 1020 put expires out of the money and worthless. 3. The short 1050 call expires out of the money and worthless. 4. The short 1050 put expires in the money with an intrinsic value of minus 20 points. 5. Total premium collected at inception, 25 points. 6. Total profit on the trade at expiration, 5 points. 25 minus 20 equals 5. 7. Total profit in dollars, $1,250. 5 times 250 equals $1,250. Now let's look at expiration at the 1070 level. 1. The long 1080 call expires out of the money and worthless. 2. The long 1020 put expires out of the money and worthless. 3. The short 1050 call expires in the money with intrinsic value of minus 20 points. 4. The short 1050 put expires out of the money and worthless. 5. Total premium collected at inception, 25 points. 6. Total profit on the trade at expiration, 5 points. 25 minus 20 equals 5. 7. Total profit in dollars, $1,250. 5 times $250 equals $1,250. At the 1070 level, both wings expire worthless. The 1050 put expires worthless, and the 1050 call expires with a value of 20 points, for total earnings of 5 points or $1,250. 5 times $250 equals $1,250. Following the same logic and methodology, it is easy to calculate the break-even point of the trade, which is expiration at the 1075 level on the call side and 1025 on the put side, excluding fees. The break-even points allow the underlying market to trade in a range of 50 points. Nothing to sneeze at, even in volatility conditions that are higher than moderate. Here is a note for option buyers. If you are contemplating buying options, you should pay careful attention to this next point. While the Iron Butterfly offers relatively small risk and the potential for high rewards for the option seller, the tables turn when the strategy is used as a buying strategy. Even in volatile markets, where the probability of a 30-point move is likely, the possibility of the market expiring at the same level in which the trade was initiated still exists. In that scenario, the market expiration will hover around the 1050 level. Both wings expire out of the money and valueless, and the center options will expire worthless or near worthless. In our particular example above, this state of affairs would represent a loss of the entire or nearly the entire 25 points paid for the Iron Butterfly at inception. We like to compare this risk profile to the African plants. The longer you stick around the watering hole, the more likely you are to get eaten by a lion. Options buyers will either pay close attention or pay a dear price. And while on the issue of buying, let's move to another type of a butterfly spread, this time taking a detour to the world of options buying and understanding the directional long butterfly. Here's to your success, and remember, there is substantial risk of loss in trading futures options. Remember that past performance is not necessarily indicative of future results, and remember that only risk capital should be used. We hope to see you soon.